In this video, we're going to be talking through error corrections and how to catch errors. This is one of the activities that is common at month end when you're closing the books. It's not like that you can't catch them before then, but a large amount of activity is happening in month end to try and make sure that what we're reporting is accurate. So how do errors happen? Well, mistakes can happen in all kinds of different ways. And this is because software very often is not programmed to catch every possible error that could happen. Some common examples are things like a purchase order could get set up with a product cost that's not accurate, or an invoice could come in that gets coded to the wrong account. Or software itself, I have been at many a client in the past where software is just, it was built for a certain purpose maybe 30 years ago, but with the advances in technology, with the advances in processing and all that sort of stuff, it just doesn't quite catch everything, and there could be real gaps and holes in how it captures information. And that is an extreme case, but I have seen it happen. So how are errors found? One way is, initially, when I was talking to you in a video about some foundational elements of accounting, every account that's in the chart of accounts has what's called a normal balance. And that normal balance, let's say for a cash account, is a debit. And at the end of a month, as an accountant looks at the cash account, if they see that it has a credit balance in it, that is a big red flag because it should have a debit balance in it. So part of their job is to take a look at that account, see what has gone in and out of that account, and see if they can find that there is an error of some kind or something else that's causing it to do that. Another way that you can find errors is accounting software today allows for exporting of data. So if an accountant is responsible for some certain accounts in the chart of accounts, they can export that data, however much data there is, out into Excel, and then they can manipulate that and look for possible errors. And finally, at month end, one of the things that accountants are doing is doing account reconciliations, and they have to do this for assets and certain liabilities and variance accounts because they have to verify that what is being represented in those accounts is truly accurate, and they have a whole lot of different ways of being able to do that. So how are these errors fixed? So let's go through a couple of examples one at a time. One is we have a purchase order get set up with an item that has a cost of $1, but the cost actually should have been $1,000, and the purchase order is for a quantity of 10. So if that pricing error is not caught before the items are received, then upon receipt, a journal entry is going to be recorded, generally automatically in most software systems today, where $10 is recorded as a debit to inventory and $10 is recorded as a credit to accounts payable. However, this entry should have been for $1,000 to both accounts. So an accountant could possibly catch this on an export of data, and they're looking at goods receipts and they notice, oh, we have a problem here. So in order to make an adjustment to get both accounts to that $1,000, they would need to make an adjustment for $990. So there would be a debit to inventory for $990 and a credit to accounts payable for $990. In example number 2, we have someone who gets a phone bill. They code it to the electricity account by mistake, and the error is discovered when the phone account does not have an entry for the month. Somebody catches it that way. And this correction would then be to credit the electricity account where it went erroneously, and then debit the phone account, which is where it should have been in the first place. So for accountants, their job is to look for errors. Part of their fiduciary responsibility in a company is to make sure that they create accurate financial statements. And non-accountants can also be the eyes that look for certain problems in data, because other people besides accountants are responsible for budgets or certain accounts in the general ledger, and they also can be on the lookout for things that look funny or don't quite make sense. So still, a non-accountant may still need to call the accountant to do an investigation, that's perfectly fine, and the accountant will be the one to actually make the adjustment in the general ledger. Finding errors can really be a challenge, but sometimes finding the error is not the problem. It's the fact that trying to figure out what the root cause of it is and being able to fix it so it doesn't happen again, that's oftentimes the even bigger challenge that people have in front of them. So I hope that helps to understand what error corrections are and why they can happen in an organization and how an accountant would go about fixing them. And I look forward to talking to you on another video, and I'll talk to you then. Thank you.